Welcome to the Gamma Brief by Gexlog.com. I'm your host, Alex. At the Gamma Brief, we don't trade the headlines, we trade the structure. Every morning, we strip down the market mechanics, gamma exposure, dealer flows, and volatility regimes, so you can trade the math, not the noise. As always, this is market intelligence, not financial advice. Now let's get into the levels. It is Wednesday, February 18th, 2026. ES futures are trading at 68.90, up nearly 50 points from yesterday's close. But do not mistake this overnight bid for structural health. VIX near 20 inside a negative gamma regime means liquidity is thin and moves are exaggerated. If durable goods at 8:30 cracks the narrative, that 50-point overnight gap becomes an air pocket for rapid liquidation. Let's break down the mechanics. We remain in a negative gamma regime. Dealers are short gamma, meaning they are trading with the momentum, buying rips and selling dips, which amplifies volatility rather than dampening it. Yesterday, we saw this fragility when the SPX nearly tested 67.75 before a short covering rally saved the close. Today, the overnight gap up to 68.90 effectively stretches the rubber band. Dealers are not here to provide a floor, they're here to chase the tape. Expect whippy, accelerated price action on any data surprises. Here is your battlefield for this session. Our neutral zone equilibrium has shifted higher with the futures. The upside pivot to watch is R2 at 69.25. Clearing that invites momentum chasers. However, the critical downside pivot, the trapdoor, is yesterday's close around 68.43. Below that, we re-enter the 67.93 support zone. Note the huge gap between current prices and that support. In negative gamma, that empty space is an acceleration zone, not a cushion. Overnight, the futures drifted higher on two main drivers. First, the continuation of cyclical rotation we saw yesterday, with capital front-running today's data under the assumption that the recent tech weakness is stabilizing. Second, we saw pre-positioning ahead of the FOMC Minutes, a classic climb the wall of worry dynamic, where traders are buying anticipation rather than the fundamental reality. Your risk radar is lighting up red today with a calendar risk score of 5 out of 5. The primary threat hits at 8:30 a.m. Eastern with durable goods orders. The market expects a significant contraction of negative 3.2%. A print worse than that confirms recession fears that could violently reverse the overnight bid. We also have the FOMC Minutes at 2 p.m. This is a double-barreled event day. Asymmetric risk is to the downside. Markets are priced for perfection with the gap up. A data miss has a long way to fall. Structurally, this is a long gamma day. Income strategies like iron condors are extremely dangerous here because the range is unstable. You want defined risk convexity, long puts or calls that benefit from expansion. If you are shorting volatility in a negative gamma regime ahead of tier 1 data, you are picking up pennies in front of a steamroller. Bottom line, the overnight gap is built on hope, but the gamma profile suggests fragility. Watch the reaction at 8:30 a.m. Watch the reaction to the 8:30 a.m. data. If we fail to hold the pre-market gains, the gap fill will be aggressive. The regime wants to move. Position for the break or stay small. Level set, buys defined. Good luck out there. Hit that subscribe button to keep the Gamma Brief in your daily rotation. For the full dashboard, head on over to Gexlog.com. A reminder, this briefing is for informational purposes only. I am not a financial advisor, and nothing here constitutes financial advice. Derivatives trading involves high risk and is not suitable for everybody. Trade your own plan.